Imagine you wake up and your money is losing value. Bread was $2 yesterday, now it costs 4, and next week it may cost 8. Shops might stop taking certain banknotes, and banks may run out of cash. People might rush to grab their savings, unsure if their money will be worth anything tomorrow. But such things have happened many times in history. Financial troubles and bank problems have been around for centuries.
That's where central banks come in. Almost every country has one today. We often hear names like the Federal Reserve or the Bank of England, but many are unsure of their role. These banks were created to manage the money system. With just a few decisions, they can change mortgage rates, the stock market, and even your savings. To understand their power, we need to look back to a time before these banks existed.
Before paper money, people used different things as money. In ancient times, they traded goods or used things like gold and silver coins. Coins made trading easier because people agreed on their value. But as trade grew, carrying lots of coins was hard. Traders who moved from one place to another needed safer ways to keep their money. This is how the first banks started.
In the Middle Ages, merchants began to leave their money with trusted bankers. Instead of carrying many coins and risking theft, they used written notes. These notes allowed them to claim their money later. Banks became very important for trade. As trade routes spread across Europe, cities wanted stable payment systems. An early example was in a city called Barcelona. They created the Taula de Canvi to help with safe payments.
The Taula de Canvi was followed by similar efforts in Venice, Genoa, and other cities. These institutions brought trust and helped reduce financial chaos. While these weren't central banks like we have today, they were important for bringing stability. The idea of a national bank came slowly. One of the early examples was in Sweden, where a banking experiment later became Sweden's national bank.
An important early national bank appeared when England needed money in the late 17th century. Wars were expensive, and traditional loans were not enough. In 1694, investors proposed lending money to the government. In return, they wanted special banking rights. This led to the creation of the Bank of England. At first, it was not like the central bank we know. It was a bank with a special tie to the government. But over time, it became very important in England's financial system.
The Bank of England was created in 1694. It started because England needed money for wars. They couldn't get enough from traditional loans. A group of investors came up with an idea. They would lend money to the government. In return, they wanted something special. The government agreed and allowed them to have special banking rights. This was the start of something very important in England's financial history.
At first, the Bank of England wasn't like the central banks we know today. It didn't have control over inflation or set policies for the nation's money flow. It was more like a normal bank with a unique connection to the government. However, with time, it grew more powerful. Its role in managing money and keeping trust in the monetary system became stronger. Countries around the world watched and learned from England's example.
But not every early banking experiment went well. In France, John Law, a Scottish thinker, introduced a set of ideas that looked promising at first. His bank, the Banque Royale, aimed to change France's money system. People became excited as assets prices rose, but this excitement turned into disaster. The boom ended, the bubble burst, and France faced a serious financial crisis. It's a well-known lesson on the dangers of speculation.
The example of John Law's failure teaches us something important. It shows the risks of creating financial systems based only on public excitement without careful planning. Many countries understood the need for stronger systems. Learning from mistakes helped shape future banking. While some banks succeeded, others struggled, reminding us of the need for well-thought-out plans and careful management in finance.
Let's dive into why modern central banks are important today. They are known as lenders of last resort. This idea, proposed by Walter Begehaut, is very important. What does it mean? Well, during a financial panic, banks might face big problems. If everyone tries to get their money at once, even strong banks could fail. They need someone to provide cash to avoid such issues.
Now consider a situation where a bank can't provide cash to the people because everyone wants their money. That's when the central bank steps in. In times like these, central banks lend money to banks so they can give cash to people. This helps keep the financial system stable and stops panic from growing. It's important for keeping trust in the economy.
Let's take a look at the past. In the 1800s, there were times when banks faced problems. People wanted their money all at once. Banks did not have enough cash to give. This was a big problem. Central banks started to help out during these times. Without them, many banks could have closed. This support was crucial to keeping people's trust in the financial system.
When banks are in trouble, the central banks offer the help they need. This action reassures people that their money is safe. Central banks play a critical role in maintaining financial stability. By providing emergency support, they prevent a small problem from becoming a big crisis. Without them, our financial systems would be much more unstable.
When it comes to inflation, it means prices of things go up over time. If you put money in the bank and prices stay still, your money buys the same things. But if prices rise too fast, you get less for your money. Central banks aim to keep this under control. They look at inflation and try to keep it from getting too high or too low to ensure economic stability.
Central banks use interest rates to manage the economy. When rates are low, borrowing money costs less. People buy more houses and cars, which helps the economy grow. But if rates are high, borrowing is expensive. This slows buying and cools the economy. It's all about finding the right balance. The central banks pay close attention to these rates because they impact so many parts of our lives, like mortgages and credit cards.
Besides controlling inflation through interest rates, central banks also manage the money supply. Most money isn't cash. It exists digitally. Central banks can influence how much digital money is out there. They buy things like bonds, which puts more money into the economy. If they sell those bonds, they take money out. During normal times, these steps might seem minor, but in tough times, they can be really important for keeping the economy stable.
One of the tools they use is called open market operations. Central banks buy or sell government bonds. This helps control how much money circulates. If they buy bonds, they inject money into the system, helping banks lend more. If they sell, money is pulled out, which can slow things down. It's a bit like adjusting the speed a bit by making small changes that guide the overall economy in the right direction.
In 2008, the world faced a big financial crisis. It started with problems in housing markets where many people borrowed too much money. When house prices fell, banks lost money, and they were in trouble. This affected global markets, causing a lot of fear. People worried about their savings and jobs. To help the situation, central banks had to find new ways to support the economy and stop the panic from getting worse.
One major tool they used was called quantitative easing, often known as QE. This was a way to inject money into the economy by buying government bonds and other assets. The idea was to boost the amount of money in the financial system. It aimed to encourage banks to lend more and people to spend more to keep the economy moving. QE was an extraordinary measure, showing how serious the situation was.
Supporters of quantitative easing argued that it was necessary to prevent an even bigger economic collapse. They believed it helped major banks avoid failure and kept the flow of money steady. This, in turn, supported businesses and jobs, avoiding a deeper recession. But not everyone agreed with this method. There were critics who worried about the long-term effects.
Critics of QE thought it might lead to inflation or make asset prices, like stocks and houses, too high. They were concerned that while it helped the economy in the short term, it could create new problems down the line. Some also thought that it mostly benefited big investors rather than regular people. This debate about QE and its impact continues even today, as people consider how best to deal with financial crises.
Now let's discuss the idea of helicopter money. Imagine a helicopter flying over a city dropping money for people to collect. This idea, first described by Milton Friedman, is simple and yet very powerful. Instead of putting money into banks, the central bank gives it directly to the people. This can help boost the economy by encouraging people to spend more, especially during tough times.
But helicopter money also comes with risks. Some are worried it might cause inflation or make things cost too much. Others think it could lead to problems that we did not expect. Just like with any strong tool, we have to be careful about how we use it. People are also talking about central bank digital currencies, known as CBDCs. These are digital forms of money given out by the central banks themselves.
Countries like China are already testing digital currencies. CBDCs could make it easier and faster for people to pay for things. Imagine buying your groceries without needing cash or a card. It sounds simple and efficient, but it also brings worries. For example, people are concerned about privacy because every digital transaction can be tracked. There are questions about how much control the government would have over people's money.
The benefits of CBDCs include making payments faster and reducing costs. They could also help people who don't have access to traditional banks. But there are also important risks, like security and how it changes our usual money systems. Each country is looking at their own needs and concerns to decide if CBDCs are a good idea. This new era of digital money could change many things about how we use money every day.
Think about what we discussed today. Central banks are important for a stable economy. If you liked this episode, please give us a thumbs up. It really helps us. Share your comments too, so we know what you want to hear next. We'd love to bring more interesting topics to you.